What if the US dollar just missed a critical turning point and the euro surged instead? In April 2025, the unexpected happened. The euro surged to a 3-year high, while the dollar fell below a symbolic threshold. Most didn't see it coming, but we did. And now the signs are impossible to ignore. Tariffs, tensions, a chain reaction that sent shockwaves through markets, boardrooms, and kitchen tables. What began as a bold strategy turned into global financial turmoil. In this episode, we'll trace the domino effect, from Trump's aggressive trade policies to a shift in global economic power. Trade tariffs spark currency turmoil. Trump rolled out sweeping tariffs, hitting all U.S. imports with a 10% hit, a scorching 145% on China, and a sharp 20% on the EU. Washington spun it as a shield for American industry. But Wall Street didn't bite. Within days, the euro jumped from 1.0807 to 1.1351, a gain of more than 5% by April 11th. That wasn't just a blip. It was a clear signal that investors were changing course, pulling capital out of U.S. markets and sailing for the calmer economic waters of Europe. The European Central Bank held steady, offering consistency, while Washington sent mixed signals. Even a limited 90-day pause on tariffs wasn't enough to calm the storm, especially since China was left out of the deal, suggesting deeper rifts beneath the surface. The US dollar index, DXY, slipped below the key psychological threshold of 100, landing at 99.78, its lowest level since mid-2023. In geopolitics, currency markets are like seismic monitors of global confidence. And this one was flashing red. What started as a show of strength quickly turned into a financial miscalculation. And that first crack? It was just the beginning. As investor confidence faltered, the broader system began to reveal deeper structural stress. Market chaos and economic collapse. When the tariffs landed, the markets didn't freeze. They went into chaos. U.S. Treasuries, once considered the safest haven in stormy times, suddenly became too hot to handle. On April 2nd, yields on 10-year Treasuries jumped from 4.2% to 4.43%, the biggest spike since the 2008 financial crisis. Even 30-year bonds weren't spared, posting their steepest 3-day rise since the early 1980s. Behind the scenes, a wave of complex trades, basis trades, swap spreads, and leverage positions began to unravel. Panic set in. Investors didn't wait around. They dumped U.S. debt and redirected capital elsewhere, signaling a deepening loss of confidence in America's fiscal direction. Meanwhile, Wall Street was hit hard. The S&P 500 plunged over 10% in just 2 days, its steepest drop since the early COVID crash. The Dow Jones followed suit, plunging over 3,000 points in consecutive sessions. In less than a week, over $6.6 trillion in market value was wiped out. Gold, the classic safe haven asset, surged past $3,223 an ounce. And behind the scenes, quiet concerns began to grow louder. Rumors that China and Japan might begin to reduce their holdings of U.S. Treasuries. The message was clear. Confidence in Washington's fiscal strategy was rapidly eroding on the global stage. Before we dive any deeper, take a moment to like and subscribe. It helps us bring this kind of global analysis to more viewers who care about where the world is headed. Now, let's move from market charts to everyday realities, because the fallout hasn't stopped on Wall Street. It's starting to hit kitchen tables around the world. Main Street crisis, inflation strikes hard. But this wasn't just a Wall Street problem, it was hitting American households from coast to coast. According to Yale's Budget Lab, the average U.S. household is expected to pay an extra $3,800 a year thanks to rising import costs. Everyday necessities, from kitchen appliances to electronics, saw price spikes. The auto sector wasn't spared. Deliveries of EV batteries were delayed, and manufacturers warned of price hikes on key components for both traditional and electric models. Inflation jumped an estimated 2.3% in 2025, driven by the tariff wave, ongoing supply chain disruptions, and shaken consumer confidence. The Federal Reserve slashed its GDP forecast from 2.1% to 1.7%, while the OECD projected only 1.6% growth through 2026. All of this unfolded as the US faced a towering $1.8 trillion deficit. As the dollar weakened, borrowing costs rose, adding pressure to an already strained economy. Meanwhile, currencies like the Japanese yen and the Swiss franc were quietly gaining strength. Confidence cracked. And for everyday Americans, the effects were far from theoretical. Gas prices soared, interest rates climbed, savings shrank. And as the economy lost its equilibrium, the shockwaves rippled through every industry, from assembly lines to storefronts. But while the US struggled to regain its footing, its allies weren't sitting still. They were busy writing new economic playbooks of their own. Allies rethink trade, shift gears. When the tariffs were imposed, they sent a clear signal to US allies to reassess their positions. Canada and the EU, longtime US partners, began looking for ways to reduce their dependence on American markets. Trump's 25% tariff on Canadian goods and 10% on energy imports prompted Ottawa to respond with $29.8 billion. But this wasn't just a back and forth. It signaled a deeper, more strategic shift. In early 2025, former Prime Minister Justin Trudeau met with EU leaders to forge stronger trade ties, seeking to circumvent the unpredictability of US policy. Under the Comprehensive Economic and Trade Agreement, CETA, trade between Canada and the EU has already increased by 65% since 2016. By 2022, EU exports to Canada will reach $49.1 billion, while Canadian exports to the EU will total $34 billion. The new goal? Create more diversified supply chains, forge stable economic partnerships, and even adjust defense procurement strategies. For industries like automotive, this meant rethinking sourcing strategies and reducing reliance on US-centric contracts. As Trump delved deeper into his America First approach, allies began drafting a new trade blueprint, one that minimizes Washington's influence. Meanwhile, America's rivals were gearing up for something much more significant. Endgame. Is the dollar crashing? The global economic landscape is clearly shifting. What began as an effort to bolster American industrial strength now appears to be backfiring. As US allies forge new paths, this shift isn't just reflected in reserves and bond yields, it's in sourcing strategies, pricing models, and long-term industrial planning. In the automotive sector, these changes are being felt across the board, from the rising cost of EV batteries to transatlantic supply chains and the challenges of pricing amidst fluctuating currency risks. Now let's pop the hood and hear from you. Do you think the US dollar is truly losing its dominant position? Or is it just stalling before a potential rebound? Will Canada and Europe's shift in strategy change the way automakers approach global supply chains? Share your thoughts in the comments. Whether you're a global strategist or just keeping an eye on the world's shifting gears, we want to hear your perspective. If you enjoyed this analysis, be sure to subscribe to Globelines, your ultimate destination for economic insight, global shifts, and every twist and turn in the political and financial landscape. Thanks for watching. Until next time, stay informed and keep your insights sharp. You can watch any of the videos on the screen now. There's plenty more to dive into.